Do you know that DeFi has been susceptible to hacks and fraud lately? DeFi has been touted as a hot ticket attracting millions of investments. Many crypto prophets are predicting some good returns on investment in DeFi. Will this gamble pay off? Probably not, and here is why. Number 5. Hackers are a threat to your investment. The advent of cryptos came with many opportunities as well as risks. The idea of liberty from centralized financial control has never been appealing. If you have been following the cryptocurrency landscape for a while, you might have heard many crypto experts and amateurs alike use DeFi. Anyway, the goal of keeping decentralized finance from the prying eyes of regulators may soon be a mirage. More on that down below. The foundations on which this financial economy system is built are the old-school principles of zeros and ones. And where there are codes, the natural predators you find around are hackers. Not all hackers are the same. The white hat hacker plays the protagonist, the black hat the villain, and the gray hat somewhat in between the protagonist and the villain. Unfortunately, DeFi cryptocurrencies have attracted many bad actors, mostly hackers interested in emptying your crypto wallet. According to CipherTrace, $471 million have been lost by investors in DeFi hacks and fraud in 2022. So that's just a heads up. You might be the next victim. Hit the subscribe button so don't miss out on our top-notch crypto reviews and info. Number 4. Private key requirements. What is the password of your Google account again? You have forgotten. Congratulations! If you haven't forgotten your password, you are among the chosen who will forget it and request a reset in the next 3 months. Let's face it, we all forget some crucial details from time to time, and that is the problem with DeFi and cryptocurrencies. With DeFi and cryptocurrency, users must secure the wallets their cryptocurrency assets are stored. This requirement is essential and non-negotiable for private and institutional investors using multi-signature wallets. Private keys are like the CVC on your ATM card. But in contrast to just 3-digit CVC, private keys for crypto wallets are long and randomly generated codes known only to the users. These strings of codes serve as a signature to secure the wallet. If a private investor loses their key, they lose access to their funds forever. Some people go around this problem by writing it on paper or saving it on their computer, which is equally dangerous should it fall into the wrong hands. Your private key falling into the wrong hands isn't the only potential risk a DeFi investor can face. This would be explained further down this video. Number 3. Pending regulation of DeFi. Decentralized finance, or DeFi, refers to financial applications built on blockchain technology that enable digital transactions between multiple parties without the traditional banks serving as middlemen. So one can access services like a loan, interest-earning accounts, money transfers, insurance, and cryptocurrency exchanges without the traditional banks acting as intermediaries. DeFi crypto or tokens are used on crypto exchanges to facilitate these transactions. The intention of DeFi to disrupt the traditional banking system has brought it under the radar of regulators. The Security Exchange Commission, the Treasury, and various authorities have raised the need for additional controls. The Financial Action Task Force, FATF-AG7-backed institution that was established to combat money laundering, insists that DeFi is an easy avenue to launder ill-gotten wealth, hence the need for regulation. Should the FATF restrict any jurisdiction for any reason best known to them? Crypto assets belonging to an investor in the affected territory could be frozen or permanently lost. Number 2. Flash loan attacks. At this point, I would have you think of Flash of DC Comic. His speed and agility are equivalent to the rate at which Flash loan attacks are undertaken. Flash loans are an uncollateralized lending method popular in the DeFi space. Traditional centralized banking disperses loans using 2 techniques: unsecured loans, which require no collateral because the amount loaned is small, and secure loans, which require collateral like a car, investment, or property. This way, the bank can assess and minimize its total risk. However, with DeFi, the story is different. The concept of a flash loan attack is simple. A borrower requests and receives crypto assets worth thousands of dollars without putting up any collateral. They have to pay the total amount back within the same transaction sent, within a few seconds. If the loan is unpaid, the lender can reverse the transaction as if it never happened. Since the system is decentralized, the bad borrowers can't be flagged. Flash loan attackers borrow huge sums of money using these unique tricks and use them to manipulate the market. Some also try to exploit vulnerable DeFi protocols for their gain. Number 1. DeFi rug pulls. Rug pulls are a new type of pump and dope scam where developers create a new DeFi token, pair it with cryptocurrencies such as Tether or Ether, and set up a liquidity pool. When the pool has a substantial amount of the leading cryptocurrency in it, the DeFi developers then use backdoors intentionally coded into the token's smart contract to mint millions of new coins that they sell for the popular cryptocurrency. This scam completely drains the popular cryptocurrency from the pool and leaves millions of worthless coins in it. The founders then disappear without a trace. An example was the Sushi Swap billion-dollar rug pull in 2020. Let us know in the comment when you think DeFi would be regulated worldwide. See you in our next video.